Hey everyone, welcome back to Corporate Dakota. Today, Eva, Live Inc. just filed an 8K reporting a material definitive agreement, and I am seeing a couple of red flags that matter for investors. Quick note, this is not financial advice, just my take on public filings for educational purposes. This filing shows Eva, Live Inc. is raising money through a convertible note which comes with some interesting terms that could impact shareholders. Let's get straight into what is happening, Eva. Live Inc. entered into a securities purchase agreement with an accredited investor called Streeterville Capital LLC. This happened on the 21st of July 2026. It is a pretty standard move for companies that need cash for operations or to develop their business. What is interesting is that Eva Live Inc. is a publicly traded company with its common stock quoted on the Nasdaq, trading under the ticker GOAI. They are showing up as an emerging growth company, which means they get some flexibility with regulations. The core of this filing is the sale of a secured convertible note. Think of this as a loan that can be turned into company stock later. The initial amount is $2,160,000. This investor, Streeterville Capital LLC, also has an option to buy another note worth $1,250,000 within 24 months. So potentially, this company could raise a good chunk of money here. The deal closes once certain conditions are met, including filing a prospectus supplement. This means the shares that might be issued when the note is converted are registered and ready to go. When the deal closes ever, Live Inc. will get $2 million in gross proceeds from this initial note. They plan to use this money for working capital, general corporate purposes, and advancing their business goals. Now, let's break down the terms of this note because this is where things get a little spicy. The note is issued at an original issue discount of 8%. This means the company gets less than the face value of the note upfront. For a $2,160,000 note, that 8% discount means they are getting about $198,720 less than the principal amount on day one. It also carries an 8% annual interest rate. The note matures in 24 months. If the investor decides to buy that additional note, it will have the same terms. The real key for investors is the conversion. The note is convertible into common stock. The conversion price is set at 87% of the lowest daily volume weighted average price, or VWAP, during the 10 trading days before a certain date. But here is a critical point. This conversion price can never be lower than a floor price of $0.472. This is a crucial protection for the investor, ensuring they don't convert at a price significantly below this floor. As of the research context, GOAI is trading around $1.97. If the stock price drops significantly but stays above this floor, the investor still benefits from a discount. If it drops below the floor, they get the benefit of the floor price. The company has the option to pay back the note early, but if they do, they have to pay back 110% of the amount they're prepaying. That is an extra 10% penalty, making early repayment quite expensive. There is a protection for the investor if the stock price tanks. If the closing price stays below the floor price for 10 consecutive trading days, the investor can redeem their note. This means they can demand their money back or potentially convert it at favorable terms. Then there are trigger events. If a major trigger event happens, the investor can increase the principal amount of the note by 10%. For a minor trigger event, it is a 5% increase. This can happen up to 3 times for each type of event. These trigger events are defined in the note and could include things like the company not meeting certain financial covenants or facing significant operational issues. If the company can't fix these trigger events within 5 trading days, it automatically becomes an event of default. And if an event of default happens, the investor can demand immediate repayment of the entire outstanding balance. Plus, the interest rate jumps to a hefty 15% per annum. This is a significant increase from the initial 8%, and it comes with accelerated repayment demands. And to top it all off, this note is secured by a security agreement. This security agreement means Eva, Live Inc., is pledging collateral. This collateral includes things like equity interests in its subsidiaries, customer accounts, insurance contract rights, and even its goods and equipment. Essentially, they are putting up a significant portion of their assets to back this loan. If they default, the investor has a claim on these assets. The filing also mentions that the shares issuable upon conversion of the note were registered under a shelf registration statement, which means the company had pre-registered shares for future sales. This was filed back in March and declared effective in March as well, but the prospectus supplement was filed on the 23rd of July, 2026. Aligning with this agreement. Looking at the exhibits, we see the form of the initial note, the security agreement, and an opinion from legal counsel. These documents likely contain the full detailed terms and conditions of this financing. The report is signed by David Bellet, who is the president and CEO, on the 23rd of July 2026 now. Let's bring in some outside context. Eva Leaving is in the technology software infrastructure sector. Their market cap is around $72 million and the current stock price is $1.97, trading well below its 52 week high. They also have a very small employee count, just 3 people. Recent news shows they are actively working on deals. There was a headline about a proposed deal that would give them access to over 260 patents, and another about a letter of intent to acquire Airbeam Wireless Technologies to advance AI-powered communications. This suggests the company is trying to grow through strategic acquisitions and patent acquisition, likely to bolster their technology offerings. However, this financing raises some questions. Raising money through a convertible note with a floor price and triggers can be a double-edged sword. On one hand, it provides needed capital. On the other hand, the terms suggest the company may be facing financial pressures or anticipating future ones. The 87% of VWAP conversion price with a floor means that if the stock price drops significantly, the conversion can be very dilutive to existing shareholders. If the stock price were to fall to, say, $0.5, investors would be converting at $0.435, potentially issuing a massive number of new shares compared to the current price. The fact that the note is secured by company assets, including subsidiaries' equity, is a significant risk. If the company defaults, those assets are on the line. The 15% default interest rate is also a major red flag if a default scenario plays out. Considering their small employee base and market cap, this deal is substantial. It is a big bet on future growth, but it comes with substantial dilution risk and the potential loss of assets if things go south. The risk I am watching is how much dilution this convertible note will cause if the stock price doesn't recover significantly. What I am actually looking for is whether their proposed acquisitions can truly move the needle to justify this kind of financing. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If you found this deep dive helpful, please like, subscribe, and join our Discord community for more.